let's be honest, does investing sometimes feel like a game you're just set up to lose? You buy something, it goes up a little, and you feel great. Then it just plummets. It's this super frustrating cycle, and it makes you feel like you're missing some secret piece of the puzzle. Well, today, we're going to talk about that missing piece, a strategy that pretty much flips everything you've been told on its head. So, what is your plan? Really, think about it. For most of us, it's kind of just buy and hope. You find a company you like, a stock you believe in, you put your money in, and then you just cross your fingers and hope for the best. But what's the plan for when it goes down? And I mean really down and stays down. If your answer is something like, well, I'll just wait for it to come back up, you're definitely not alone. But you might be in some serious trouble. This story, man, it just perfectly, if maybe a little brutally, shows the danger of that wait and hope mindset. It sounds completely absurd when you're talking about a knife in your foot, right? But psychologically, it is exactly what millions of investors do every single day. They just sit there, passively waiting for a losing position to magically recover, all while ignoring the very real damage that's happening right now. And that right there, that brings us to the absolute core of the problem, what we can call the investor's dilemma. It's this huge, fundamental flaw in how most of us are taught to think about the markets. And it all comes down to the simple, terrifying fact of having no exit plan. Think about the popular advice you hear from places like The Motley Fool. Their whole origin story is about buying a stock just because you like the company's chocolate pudding. It's a cute story, right? And it gives you a reason to buy. But here's the thing it never, ever tells you. When do you sell? When the pudding starts to taste bad? When their sales dip a little? The story gets you into the trade, but it leaves you completely stranded with no map to get out. So, what's the alternative? Well, it's about shifting your entire perspective, from being an investor to having a trader's mindset. Now, this doesn't mean you have to become some frantic day trader glued to a screen. No, it's a deep philosophical shift about what information actually matters. The market's biggest winners, they don't focus on stories or putting. They focus on just one thing, the price. And you can see the two worlds laid out right here. It's night and day. The investor buys and hopes. They rely on stories and fundamentals. They have zero exit plan, and they just hold on to their losers, praying they'll come back. The trader, on the other hand, plans and reacts. They only trust what the price is doing. They have a predefined exit for every single position, and they get out of losers fast. It's the difference between being a passenger on a plane and being the pilot. And this quote from the legendary trader John W. Henry just nails it. Trend followers do not believe they can predict the future. In fact, their entire strategy is built on the idea that nobody can. Their profits, he says, come from taking advantage of all the people who think they can predict the future. They simply react to what the price is actually doing right now. Okay, but does this whole reacting to price idea actually work? You gotta remember, the market is a zero-sum game. For every single dollar that is lost, a dollar has to be won by someone else. So when you hear about these massive financial disasters in the news, the media always focuses on the losers. They almost never ask the most important question. Who was on the other side of that trade? So let's take one of the most famous financial blowups in history, long-term capital management, or LTCM. This was a hedge fund run by literal Nobel Prize-winning geniuses. These guys thought they had a perfect mathematical model that could predict the markets. But in the fall of 1998, their model just shattered. They lost billions and nearly took down the entire global financial system with them. The smartest guys in the room got completely wiped out. So if they were the losers in this zero-sum game, who were the winners? Who was collecting all the billions of dollars that they were losing? Well, here's your answer. And it's stunning. While LTCM was imploding, traders who were using trend-following strategies were having some of their best months ever. Look at this. John W. Henry was up over 17% in August. Dunn Capital up almost 13% in September. They didn't predict the crisis was coming. They just reacted to the powerful price trends the crisis created. So how do they do it? It's not a crystal ball. It's not some kind of magic. It's a disciplined, repeatable system that's based on just a few core principles. The best way to think about this is the Moneyball analogy. For decades, baseball scouts operated on gut feelings and old biases. Then a new guard came along and realized that if you just ignored all that and focused on the data, on what actually wins games, you get a massive advantage. Well, trend following is the money ball of finance. It replaces subjective stories and gut feelings with objective data.
And the whole strategy really boils down to these 4 pillars. First, the price is everything. It's the only truth. It contains all the information you'll ever need. Second, you follow the trend that exists. You don't try to guess when it's going to start or end. Third, and this is probably the most important one, you manage risk religiously on every single trade. And finally, you apply the same logic across dozens of different markets, from currencies to corn to stocks.
That third pillar, risk management, is absolutely everything. This quote from the trader Amos Hofstadter says it all. If a trade goes against him, even just a little bit, he is out, done. He doesn't care about the potential reward, the cheese, if the trap has been sprung. His number one priority is survival. You have to cut your losses small so you can still be in the game to ride the really big winners.
So what's this all based on? It's a really simple observation, actually. Things in motion tend to stay in motion. A price trend, once it gets going, is statistically more likely to continue than it is to reverse. And this means trend followers are not trying to buy low and sell high. Their goal is to buy high and sell even higher.
Now, to really embrace this kind of thinking, you have to unlearn some things. You have to get rid of the dangerous myths that Wall Street sells us as gospel. These are the so-called holy grails that keep most investors trapped in that cycle of losing. All right, let's start with the first and maybe the most toxic piece of advice out there: averaging down. You know the idea. If you bought a stock at 50 and it drops to 40, you should just buy more to lower your average cost. The legendary trader Paul Tudor Jones had a sign on his wall that said it best: losers average losers. I mean, think about it. Why would you throw more good money at a decision that has already been proven to be wrong? You're not lowering your risk. You are concentrating your risk in a failing idea. The next myth is this idea that the experts you see on TV or the analysts at the big banks have any clue what's going to happen. You're told to listen to their price targets and their buy recommendations. This quote from Dave Barry is hilarious because it's just so painfully true. Take the Enron collapse. As the company was literally disintegrating into dust, Wall Street analysts who have massive conflicts of interest still had buy ratings on the stock. They are not there to help you. They are there to generate business. And finally, we get to the most sacred myth of them all: the idea that buy and hold is the only safe, sensible strategy for the long run. This quote just perfectly exposes this psychological trap. Buy and hold often just becomes a fancy excuse for not admitting you made a mistake. When a stock is going up, you feel like a genius trader. When it's going down, you suddenly transform into a patient, long-term investor. That kind of inconsistency is a recipe for disaster. So all of this leads us to one last question. The market is a tough zero-sum game. The profits for the winners have to come from the pockets of the losers. And conventional wisdom, buy and hope, average down, trust the experts, that's the playbook for the losing side. So the real question you have to ask yourself is, are you playing to win?